Hey everybody, Mike DeAndre here. Today we are going to go through Secure Act 2.0, which is the new retirement legislation that came out at the end of last year. So HR 119, setting every community up for retirement enhancement Secure Act. Love those federal government acronyms.
You're welcome.
There's a lot of cool provisions, so let's hop into some slides here. Generally speaking, we're going to talk about distributions, contributions, penalties, catch-up provisions, and try and take the complexity, because let me tell you, there is tons of complexity in this new legislation.
Incredibly complex.
But there's good stuff too, and we don't want to miss it just because it's a little bit complex. Things that did not change, okay? And there are some broad areas here. There were no changes to Medicare, which is good news. There were no changes to Social Security. And if you have been or would like to start using the backdoor Roth provisions, this was something that was rumored. Is it going to go? Is it going to stay? It was sort of floated. It is still in.
Yes, yes, yes.
It is still available to do. So backdoor Roth was left alone, Medicare left alone, Social Security left alone. So we don't have to think about any of those provisions or any of those areas as we're going through this content. When we go through these slides, you're going to see they're kind of broken down into two primary categories. Changes, tax changes that impacts folks who are near or in retirement, and then changes that are impacting people who may have years still of planning and savings ahead of them. Okay, so these are sort of the two primary groups that are impacted based on the things that we're going to take a look at today. First thing is RMD beginning date changes. So big picture numbers are age 72, age 73, and age 75. Those are the key ones you want to remember. The previous Secure Act 1.0 took RMD beginning date ages to 72. Secure Act 2.0 gives you two triggers. If you turn 73 and 23, or if you turned 75 and 33. Okay, so those are the two ages that are demarked, but this is sort of an easier way to remember. If you were born between 51 and 59, your RMD age is 73. If you were born in 60 or younger, 60 or later,
Different time, the 60s.
then your age is 75. Okay? Excise tax penalty reductions. So the nastiest penalty in the tax code used to be the RMD penalty. It was 50%. They have changed it down to 25, and in some cases down to 10%. If you remember way back when, if you missed your RMD, it was kind of a big deal. If you did nothing, you were subject to a 50% penalty. But if you identified that you missed the RMD, you found out, put your hand up and say, hey, IRS, I missed it. I'm really sorry. I apologize profusely.
I apologize unreservedly.
Here is the reasonable cause for why I missed it. I have a great explanation.
I guess I forgot.
Here's Form 5329. And I already took the distribution. I already took the tax. I'm a wonderful tax person, payer, citizen of this great land.
There's a little thing called patriotism.
Please waive my 50% penalty. They pretty much always did. There was a way to get that 50% penalty down to zero. Pretty reliable way to get that penalty down to zero. So what they've done is they've basically said, all right, we're going to make it 25. Yay, aren't we awesome? And if you file some forms and raise your hand and pay the tax really quick, we'll take it down to 10.
Oh, how sneaky.
Well, it's still not zero. So you're looking at something that's really an increase in taxes, but it is an adjustment. But at the end of the day, you're going to have to track your RMDs, make sure you take them. As soon as you identify one's not taken, put your hand up, pay it, follow the rules, which in this case now is going to be filing a corrected return, pay the tax in a timely fashion, and you could see yourself, instead of having a 0% penalty, only a 10% penalty, but not a 50 and not a 25. Roth plan distribution rules have changed. So going forward, there's no RMD on Roth accounts.
Yay!
So this is rather straightforward, but very, very nice. Keep in mind, though, it is not retroactive. So this does not apply to distributions which were required before the act started, which is basically all distributions in 2023. If you trigger an RMD, you're going to want to make sure that you take your RMD out of that Roth bucket, but going forward, you don't have to. Increased catch-up contributions to retirement accounts. Couple numbers here. Big picture. Think 6,500 is now 10,000 or 50%. All right, we'll get to the details here in a second. And then really importantly, ages 60, 61, 62, and 63. Those are the years in which, or the ages rather, that you get an increased catch-up contribution. If the plan allows, That's going to be a phrase we hear a lot. Catch-up contributions, okay? Your catch-up contribution is going to increase to $10,000 or 50% of the regular catch-up amount. This starts in 2025, and again, it is only if once you attain the age of 60, 61, 62, or 63. So if you're 64, no bueno. 65, same thing. This is just for those 4 years that you have the opportunity to make these additional catch-up contributions. 2025 and beyond, all of these catch-up contributions are indexed for inflation, so they will continue to ratchet higher over time. Now, here's a little bit of a gotcha, or just something to be aware of.
Oh! Got me again.
And again, this is in the increased catch-up contribution is Section 109 of the Act. In Section 603 of the Act, there is this little piece of information here. If you earn more than $145,000 a year, your catch-up contributions can only go into a Roth bucket. So you can make your regular deferrals for your regular contributions, but if you want to make catch-up or excess contributions, then, and you make over 145 and you're of those ages, 60, 61, 62, and 63, that has to go into a Roth bucket. Whether or not that's a good or bad thing, it's going to be different for each individual, but it is good to have some tax diversification. You don't want to retire with all your money coming out of qualified plans. That's a really bad situation to retire in and to die in, but this is going to force those dollars for higher compensated employees to go into Roth buckets, but you still can put the money into the retirement account. Index catch-up limit for the IRAs. So previously, IRA catch-up contributions were not indexed for inflation. This is rather simple. Going forward, they will be. So catch-up amounts will be indexed for the inflation going forward in $100 annual increments. This starts in 2024. The Roth match. This is pretty cool. Previously, if you were contributing to a employer's retirement plan and they had a Roth bucket, you couldn't be matched in the Roth bucket. Your match dollars went into the deferred bucket. All right. Going forward, you'll have the ability to have that done. But remember, it's if the plan allows. And this does go into effect immediately, but that if the plan allows, the plan will have to be amended. Ask your employer. This is in Section 604 of the Act, but it's a pretty cool provision if you can take advantage of it. Simple contributions. Simple IRAs are anything but. They aren't the most complicated thing in the world, but still not very straightforward. But going forward, know that you can make Roth contributions and you can make higher contributions if you have a simple IRA or your employer has a simple IRA that you participate in. Going forward, important thing to know is you can make Roth contributions to that simple IRA. I've heard this referred to, this entire act is kind of the Rothification of retirement. If you notice, there's a lot of Roth provisions and a lot more access to Roths, or the idea of paying the tax today, letting it grow tax deferred, and pulling it out tax free. So that is something we're seeing a lot of in this act. Expanded auto enrollment. If you're in a retirement account since 1998, this has been available to plans. Going forward, it's going to be mandatory for plans. So there are exceptions to this. So if you have a new business, a small business, you're a government and you have a plan, or you're a church and you have a plan, you're not obligated to auto enroll your employees. But if you don't meet one of those exclusions and you have a new plan going forward, starting in 2025, you will have to auto enroll your employees. The employee can opt out, but when you sign them up and as soon as they are at their earliest eligibility, you have to turn on their retirement account. This is going to be at least a 3% contribution, anywhere to 10. This provision also provides for annual increases of 1% up to at least 10, but no higher than 15%, depending on where you started, into that same retirement account. So it's really sort of an automated savings plan per this legislation. Again, be mindful of the exclusions, check with your employer. And again, this starts in 2025. So it's nothing that you're going to see this year. It is coming in 25. Emergency savings plans. So one of the first areas we start when we're doing financial plans with our clients is evaluating their need and the amount of emergency dollars that they have in place. This is going to make it easy for certain people to get started by doing the right thing, by saving for retirement, but also earmarking the first $2,500 of those savings for emergencies and giving you access for that. It's a bit controversial because there are some people think that this shouldn't be allowed, but on the same hand, well, sometimes life happens and it's the only bucket you have to reach into, and it's a way of avoiding a penalty to have access to your dollars. So it's not all a bad thing. It's not all a good thing. It's just what it is. You need to be aware of it.
It's not so bad.
This is available to non-highly compensated employees. You can only put 3% of your comp in, and it's capped at $2,500. So you turn it on. You're contributing 3%. Whenever you hit 2,500, when you hit 2,501, that next dollar is going to go into the Roth bucket, and you'll continue to save that way. This contribution can be matched. So the employer can see that 2,500, match it, and then that's the way you're getting $1 to do the job of many, which is a pretty cool thing. And you're entitled up to 4 withdrawals a year without any penalties or fees. The law provides for 4 withdrawals a year without any fees or expenses associated with those withdrawals. This doesn't start until 2025. And at separation of service, it's a simple rollover to a Roth IRA or distribution, because again, it's your savings money. So it shouldn't be a complicated transfer if you have a break in service with that employer. Student loan debt match. This is pretty cool. Starting in 2024, if the plan allows, you will have the opportunity to be matched on your student loan payments. If you graduate and you're starting a job and you're eligible to save into the retirement plan, but you're faced with the decision, do I pay off my student loan or do I save money for retirement?
That's a tough one.
You can now get credit for paying off that student loan and get a match into your retirement account. This is for dollars that are considered qualified loan payments, which is indebtedness incurred by the employee solely to pay qualified higher education expenses of the employee. So you couldn't use this to pay off expenses of your children and get the match. This is employee is paying off the employee student loan for qualified educational expenses, and they can get a match on those saved dollars. This starts in 2024, but it's pretty cool. And again, it's one of these things where it's going to be a plan by plan situation. 529 to Roth rollovers. So this is much anticipated and a kind of a cool thing that they finally have done, which is taking those 529 leftover dollars.
There's leftovers.
And giving you a place to port them for retirement. Previously, there was no available to do this, but if you meet these provisions, you have a 529 plan that's at least 15 years old and that is in your name. You're the beneficiary of it. You can roll up to $35,000 over your lifetime, subject to the Roth annual contribution limit. So that is a nice provision. This starts in 2024. Another withdrawal for certain emergencies. So this is another liquidity provision in the retirement account. So if you simply raise your hand and say that I have an unforeseeable and immediate financial need relating to a personal or family expense, they will hand you $1,000 out of your plan. It's repayable for up to 3 years, and no additional withdrawals are available to you until you've paid that back. So this is sort of another bucket that you have to withdraw against should there be a medical emergency. And there was a lot of these types of distributions taken over COVID. I think there's just ways to make it simpler from an operational standpoint to give people access. Again, it's a little controversial because retirement dollars are supposed to be retirement dollars, emergency dollars are supposed to be emergency dollars. But I think the reality of life, again, is that sometimes people need to reach into that account, or if they have the option, it's nice that they can do so in as tax efficient a way as possible. This starts in 2024. So theoretically, you could have $2,500 emergency and $2,500 for a certain emergency. Just raise my hand, say it's an emergency, and you got $3,500 out of your plan that you can pay back at a later date. Help for survivors. Here's another distribution that avoids the penalty. This provides for a free withdrawal of the lesser of $10,000 or up to 50% of the plan balance for those who self-certify that they have experienced domestic abuse. So you don't have to say, hey, this happened and you need court records or police report. You say, hey, I need help. I'm gonna use my own money to help myself, and I'd like to do it without a 10% penalty. And this provides you with that opportunity. So this starts in 2024. It's designed to help you escape, hire an attorney, reestablish, protect yourself with your own dollars. There is still going to be tax on that $10,000 distribution. But if you take out 10, you pay 3 in tax, and 3 years later, you've put the 10 back in, you can get a refund for the money that you paid in tax. So you're even, Steven, you're back caught up. And that's kind of a cool situation and provision. I mentioned wanting to provide some materials that go along with this legislation. This is a lot of information, and if you've been writing things down, that's great, but I'm going to provide the presentation slides, make those available, a list of all the provisions. We didn't cover all 92, obviously, so there's many more things that could be specific to your situation. There are provisions for firefighters, for military spouses, for small businesses and pension plans. There's a variety of other things that are really good that are in the new act, but we wanted to cover the most broad, far-reaching pieces in this piece. Presentation slides, the 2023 tax rates on how everything, basically, this is sort of how all these numbers translate into real life for 2023. 2023 retirement checklist. What are the things you would need to do if you're planning on retiring this year on a quarter by quarter basis based on these changes? And obviously there'll be future content updates as we get either clarification or modest changes to the rule, which is just always the way that it is. If you're watching this on a computer and you want to hit your phone up with a QR code, that's great. There's a link in the description. You're on your phone right now that can take you to the site. Scroll down to the subscribe button. You can subscribe there. On my website, you can subscribe on YouTube, and then there'll be content like this posted to Instagram and to LinkedIn. So there's a lot of ways that you can engage, but just let me know that you'd like this information and we can make it available to you so that you can work on getting through all of these situations as it relates to Secure Act 2.0. So thank you for listening. I know this is a lot, but it's really good stuff. And if it can make a positive impact in your financial future, that's great. And I'm glad I could help provide this to you. If you'd like specific help in this and how this relates to your situation, I'd be glad to help with that as well. Our contact information is kind of easy to find in all of this, but have a great rest of the day. And I hope that Secure Act 2.0 treats you well. Take care.